MLPs, Master Limited Partnerships. Hard to believe we haven't done this one because you and I have talked about it in various different contexts, but here we are. We are officially doing MLPs today. What do we need to know about these?
High time. Well, they're very popular right now for one very simple and very good reason. They actually throw off some genuine yield, even in this environment, so that's kind of an exciting feature of them. To give you a little background, they were created back in the 80s. Congress wanted to encourage the creation of an energy infrastructure in this country, so they created these vehicles with some special tax benefits we'll talk about in just a second. There are 85 or so of these out there right now with $300 billion of market cap. They trade on exchanges, but the cool thing is that they're not taxed at the entity level.
Okay, so right away, that's probably sending out all kinds of signals, also from providing yield, but then how are they taxed? We'll talk about the tax thing first.
Right, so they're not, they're partnerships, MLPs, Master Limited Partnerships, so they don't bear tax at the entity level, and that allows them to pass through, a big chunk of their income without subjecting to that normal corporate tax. And so right now these things are averaging something like 6% yield, which is, of course, in and of itself very attractive. But in addition, that income stream that's coming back to the investor is actually taxed as a return of capital, which means you don't pay tax on it. So it's 6% heavily favored yield, and in addition to that, these things, unlike other kinds of organizations, are operating entities, so they look to increase that yield over time.
So is this then a unique investment vehicle? Is there anything out there like this?
Is there really? I can't readily think of anything like this because there are other entities that are publicly traded and don't attract tax. So REITs don't do that, royalty trusts, other things. But those entities are typically not operating entities. They're not actually business enterprises. Normally, if you're a real business enterprise with active management, you have to pay tax at the corporate level. That's not true with MLPs.
Okay, so if you're getting yield and you're not paying high taxes, this sounds like too good to be true. What are the downsides?
They're pretty attractive. So, of course, everything does have downsides. And here, probably the single biggest risk is in a given MLP is counterparty risk, because mostly we're talking about energy infrastructure MLPs here that own things like pipelines, and they essentially rent out the capacity in their pipeline to other users, and so they got to make sure that you receive the rent. But the good news is the people paying the rent are people like Exxon and Chevron and the larger oil and energy companies. Yeah, reasonable credits, I'm given to understand. So that's probably not an enormous risk.
All right, now what about duration risk? How long is your money tied up for?
Okay, this is a great, excellent point, because these things are, in fact, of course, yield plays. That's what we led with. And any yield play is going to have some sensitivity to changing interest rates. Certainly, these will too. So you have to pay attention there. However, the big difference is that, as I said a moment ago, these entities are capable of growing their income streams. Two ways, by the way. One is by buying more assets that they can sell more capacity, and the other is raising the rents, essentially, on the capacity that they already have. And because of that, currently, MLPs are averaging something like 6% growth rate on top of that 6% that they're already paying. And as a result of that, you don't have the same kind of duration risk you have with a true fixed income instrument.
All right. Now, what if somebody is just a very basic investor, not somebody with tons and tons of money? Can you get to this through a mutual fund? Can you get to this through an ETF?
Another superb point, because they do have MLP mutual funds and they do have MLP ETFs. However, there's a big asterisk on those, which is that generally speaking, those will wind up, for vagaries of the tax rules we won't bore the listeners with right now, those do tend to wind up attracting corporate level tax. So you're kind of giving up one of the big advantages. It's much cooler if you can own these things directly in your own account and pick up all the yield and the tax advantages as well. So one thing that people do to achieve diversification, given that the ETFs and mutual funds don't really work here, is they go to a really high quality manager who will run a separate account with a diversified portfolio of MLPs in it.
All right, now what else do we need to know? Because there's always the one or two questions people should ask that don't know to ask.
Right, a couple of little details that are kind of annoying. One of them is because they are partnerships, these things tend to operate in multiple states. You have to pay tax, you have to file a tax return in each of the states in which the thing is doing business. business. So it's better if you have an accountant.
All right, so it's a little
frankly.
clunky.
That's one. And the second one is they're not good for IRA investors because they're already tax exempt, number one, and number two, they can throw off unrelated business income, and that's a no-no for IRAs.